Picture this. You just had a hard month at work, slaving away, flipping burgers at your local McDonald's. You're in bed when an email pops up. You've been paid $2,000, but your bank account only shows $1,456. You scroll down the stub: federal income tax, state tax, Social Security, Medicare. This is the modern ritual of giving away a chunk of your money to invisible forces. And they expect you to say thank you. Here's the deal. Taxes are the cost of civilization. You pay. The government builds roads, funds schools, and ensures your taco truck is clean. There are different types of taxes. Income tax hits the money you make. Sales tax hits the money you spend. Capital gains tax hits the money your investments made while you were asleep. Nearly everyone pays Social Security and Medicare tax. Social Security is the government forcing you to save for retirement. Medicare is a health insurance tax that supports older people or those with serious health issues. Now comes filing your taxes. The government already knows how much you owe, but it makes you guess. If you're right, no worries. If you're wrong, you're cooked. When it comes to actually paying, some people pay every few months, some pay yearly. And then there are those people who don't pay at all and end up in documentaries. Look, taxes are annoying, but it's not all bad. Countries with higher tax rates generally have a higher quality of life all around. So you walk into a bank, hand the cashier your money, they count it, smile, and tell you it'll be added to your account. You walk out thinking, great, now it's sitting in a vault somewhere, being guarded by a dragon. But in reality, that money is already gone. Most people think of banks like a big safe with one job, guarding your cash. But in reality, they're just a middleman, a matchmaker for financial transactions. When you deposit $1,000, the bank takes $900 of it and gives it to someone who wants to buy a jet ski. That system is called fractional reserve banking. It relies on the idea that not everyone will show up at the same time asking to withdraw 100% of their account. Unless it's 2008, when people lined up to pull everything out and the entire system crumbled. Banks make money by lending YOUR money at a higher interest rate than they give you. That's really it. You're the supply. The borrower is the demand. Okay? They entice you to deposit because it's easier to pay by card than carry cash. They literally pay you interest to hold your money, and it's far safer than a shoebox under your bed. In the US, most banks are insured up to $250,000 per person. No matter what, the government guarantees your money up to that amount is safe. Imagine you borrowed $1,000. You have to pay back $1,280. Why? Because of interest. Interest is money's way of charging rent to exist in someone else's hands. When you borrow, interest is the price tag for using someone else's cash. When you save or lend, interest is the reward for being patient. There are two main types: simple interest, flat fee, thanks for playing. Compound interest, every dollar you owe now has clones, and they also want rent. Let's say you owe 20% interest on a credit card. You miss a payment? Now your interest is earning interest. So when your $12 burrito turns into a $50 regret. On the flip side, investing at 7% annual compound interest. That's your money, duplicating itself like a cheat code. $100 becomes $200, then $400. And one day, you wake up old, rich, and a little smug about it. This is why interest is the silent engine behind both wealth and debt. In loans, it's the slow burn that turns small mistakes into financial fires. In investments, it's the time bomb that turns small gains into massive wins. So what's the hack? If you're paying interest, kill it fast. If you're earning interest, let it sit, feed it, and give it time. Interest is either your worst enemy or your best unpaid employee. The choice is in who's collecting it. Okay? You buy a bag of chips, open it up, and it looks like it's already been half-eaten. You check the price, minus 30% higher than last time. Congratulations, you've just been hit by inflation. Inflation is what happens when money slowly gets less valuable over time. Not overnight, not with fireworks, just a slow erosion. Your $5 bill is still technically $5, but it buys less noodles, less gas, less of everything. So what causes it? Sometimes people just have too much money. Everyone's got cash, and they all want the same stuff. 2,000 people want a $500 TV, but the store only has 1,000. The store goes, that'll be $800 now. Sometimes it's supply chains. It's problems making goods more expensive to produce means the price of those goods must rise. And sometimes it's just expectations. If people think prices are rising, they spend more now, which drives prices up faster. It's a self-fulfilling economic prophecy. A little inflation is normal, even good. 2% a year, it's fine, predictable. But if it spikes, savings die, wages lag. The government fights inflation by raising interest rates. When borrowing becomes more expensive, people spend less, which cools the economy down. A recession is when the economy shrinks for at least 2 consecutive quarters. That's 6 months. One day, you're fine. Job's good, bills are paid, you might even be planning a family trip. Then, suddenly, layoffs. The stock market only going down. In a recession, jobs vanish, companies cut costs, and everyone saves for necessities instead of buying things they don't need. Why does it happen? Could be high interest rates making borrowing too expensive. Could be a global crisis, war, pandemic, a rogue cargo ship. Or it could just be the economic cycle doing what it does best. Boom, peak, bust, reset. Think of the economy like a party. In the boom phase, everyone's dancing, drinks are flowing, but eventually the lights flicker. Someone checks their bank account, and suddenly the DJ's playing sad lo-fi beats about corporate downsizing. Recessions aren't forever, they're resets, painful ones, okay? Governments might lower interest rates, send out stimulus, or just hope people start buying overpriced coffee again. Eventually, spending returns, businesses rebuild, growth resumes, but not without scars. A credit score is a shadowy algorithm that knows your name, your past, and your payment history. Right? It's a 3-digit number from 300 to 850. This number decides whether you get a house, a car, or a high interest rate on your new TV. This number isn't about wealth, it's about trust. Lenders want to know, will you actually pay me back? Below Wu Baling, you're a walking red flag. Over 750, sparkling with adult credibility. Most people land somewhere between 640 and 790. How is it calculated? Payment history is the big one. Do you pay on time? Then credit utilization, credit age, credit mix, and new accounts. To improve your score, make required payments before the late period kicks in. Miss it, your score takes a hit. Your credit score is like a pet dog. Ignore it, and it'll ruin your life. Take care of it, and someday it might help you buy a house. You can have zero debt and still have a terrible score if you have no credit history. Yes, the game is rigged. But if you learn the rules, you can rig it back. Here's the weird part about money. It's not actually real. Humans invented money to make the world easier, to make trading simpler, helps build systems, and organizes society. But there's no more inherent legitimacy in a dollar bill than in a Bitcoin, or even a stick. The only reason a dollar can buy something and a stick cannot is because we, as a society, agreed. We agreed that the dollar is worth something, and we haven't agreed on the stick. So how does money actually work? The government prints it. Central banks regulate it. And everyday people trade it for goods and services. Banks regulate it because if the government prints too much, inflation kicks in. Everyone's money becomes monopoly money. Too little, no one can afford to live. Currency is a social construct built entirely on shared belief and trust. You know what inflation is now. The best way to fight it is investing, so your money doesn't quietly lose value. Investing is what happens when your money stops sitting around and starts working for you. Instead of trading your time for money, you're trading money for more money. The problem is, there's risk involved. What can you actually buy? Stocks. Tiny ownership slices of companies. The company grows, your slice gets more valuable. Bonds. You loan money to a government or a company. They pay you back with interest. Funds. Collections of stocks and bonds, so you don't have to pick one by one. Real estate. Property. You hope someone else pays to live in forever. Investing isn't about being lucky. It's about being early, diversified, and patient. Most wealthy people didn't win the lottery, okay? They just gave compound growth 30 years to do its thing. Guys, markets go up and markets go down, okay? But the real danger isn't losing money. It's never investing and watching inflation quietly steal your future. This one's more complex, but everyone needs to understand it. Imagine you pick up a rock. It's just a rock. Now imagine that rock is shiny and yellow. Okay, that's gold. It's rare, so people place a higher value on it. But gold isn't actually worth more than an average rock. It's worth more to humans because we decided to place higher value on it. Understanding this is what allows people to become rich. Steve Jobs created the iPhone you're probably watching this on right now. He created something with enormous perceived value, so millions gave him thousands of dollars. It's the same reason doctors and lawyers earn so much. The value of their service is high, and people pay accordingly. Hey, and it's the same reason Gucci can sell the same handbag as Target for 100 times the price. People perceive it as more valuable. So it is. If you can figure out how to create value, even perceived value, you can make a lot of money. Time is the most valuable asset in the world. And the best part, most everyone starts with a lot of it. But no one gets an unlimited supply. Most people work jobs where time is traded directly for money. 1 hour, 1 paycheck. Simple math. The top earners figured out how to make their time worth millions. The difference, skills, leverage, and how well you've trained your hours to work for you. But nowhere does time work harder than in investing. There is no greater force in wealth building. Not luck, not income, time. Because wealth isn't built in days, it's built in decades. It's money that sits quietly in an investment. It doesn't just grow, it multiplies. Slowly at first, then faster. That's why ordinary people with modest paychecks can retire with 7 figures. They didn't beat the system. They used the system. A little money invested consistently, given enough time, becomes a lot.